QuickBooks Online 2021. Sales tax while recording transactions with the help and use of bank feeds. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online bank feed test file. In prior presentations, we set up the bank feeds. We entered some of the data into the system, which is now in what I would call bank feed limbo in the transactions tab. We're taking that information now, including it into the financial data as we approve the information and add any necessary details. We're thinking about the deposit side of things, and as we looked at in prior presentations, when we think about the deposits, we're thinking, of course, hopefully those are going to be revenue type of items that we want to be including in some way, shape, or form into our system. But what happens if we have to deal with sales tax? That kind of complicates the system, because then it makes it a little bit more difficult for me to just use a system where I'm going to just say, look, everything that's an increase to my checking account, I'm going to record as a deposit, because then the sales tax kind of complicates things there. So let's go over to our flow chart, which is going to be on the desktop version. You don't need the desktop version to follow along. I'm just going to take a look at the flow chart here because it has a nice flow chart. So let's first just think about the concept of a sales tax or a usage type of tax. A sales tax or a usage type of tax would be, in theory, the government imposing a tax not on the business, but rather on the customer, but forcing the business owner to be the tax collector, the person that has to enforce the rule, make sure that the customer is then paying the sales tax. So the idea then being, when you make the sale, at that point in time, that's when the government wants to charge the customer the sales tax, and they're forcing us, the business owner, to make them do that by collecting the sales tax and the revenue that we receive. We then take the portion that is the sales tax, and we have to then pay that and distribute it then to the government. So that's going to be the concept. You can kind of think of that logistically, what has to happen when I make the sale. I got to collect the sales tax at that point in time, and then I've got to track it, and then at some point in the future, I've got to pay it to the government. Now, in the U.S., we typically have the sales tax not on the federal level, but on the state level. Therefore, it will differ from state to state. But the concept of the sales tax will basically be the same, in that when we make the sale, we're forced to basically collect the sales tax. So the rates might change and so on. When we need to pay it, how far after we collect the sales, do we need to pay it every month or every quarter or whatnot? That could change. We won't get into detail on that, but the concept will remain the same. What we want to consider here is, how do the bank feeds then fit into that type of system? So notice then, when you calculate the money that you're going to be receiving, normally if you're going to set up sales tax into a full service system within QuickBooks, you would be using the create invoice or the create the sales receipt. These are the two documents that generally typically start the recording of the sales process in a normal accounting cycle. However, with the bank feed system, remember, we kind of wanted to think about the simplest bank feed system, which would mean we're going to bypass these forms if we could, right? And just say that all deposits that we get are going to be income. And then if we had a system where we wanted to record income at the point in time that we get the bank feed, at the point in time the deposit clears the bank, then what we have done is we're recording income at the deposit, and we've bypassed the sales receipt and the invoice, making it a problem to do the normal kind of sales tax calculation within QuickBooks. Now, for U.S. companies, if you do like gig work or something like that, and there's no inventory involved, then very likely you don't have sales tax, and you don't have to deal with that in that case, and that might make it an easy system to use. But if you have to pay sales tax in the U.S., possibly that would be when you sell inventory, for example, and you still want to make it as easy as possible, meaning you kind of want to wait till it clears the bank, or you would like to do as little data input, as possible, then how might we work that system that will be in place? Now, we'll talk more about the other problems with a full service system, like creating an invoice and tracking through accounts receivable. We'll do that in the future. So if you have to track accounts receivable, you're deviating from a cash basis method. And so we'll talk about that in more depth in a future presentation. And then we'll talk about the create sales receipt in a future presentation, the different kind of systems you might use that you might need independent as to whether you're using sales tax or not for other reasons. But for now, we want to basically add the sales tax to be in place. So we'll think about a system first. If you create the sales tax and you want to use one of these forms, then you can create the sales tax, and then when you generate the sale, you got to use one of these forms, and that will then charge the sales tax to the customer with the use of the form automatically, which is nice. Track the sales tax in the accounts payable that you can then later pay. However, that means that when you record, say, a sales receipt, it's then recording either a deposit to the checking account or undeposited funds. And then when you look at the bank feeds, you're going to have to match it to the sales receipt. So it's an extra step. We're not relying on something to clear the bank, but rather we're creating this form first, then the deposit will clear the bank, and then we will be matching them at that point in time. The other method you might try to use is you might say, okay, well, what if I just sell stuff and I try to include the sales tax in basically the sales price when I sell the item, and then I wait till it clears the bank, and then I'll try to basically back out what was the sales tax on a monthly basis or something like that. And that would be a method where you're trying to kind of bypass these two forms, but still, achieve your obligation of paying the sales tax. So we'll take a look at those kind of methods. So let's go back on over to QuickBooks, and if you were to turn on the sales tax, then you got the tax tracking down below, so you can go to the tax tracking down here. You've got to set up your sales tax. Now you're going to need the location in the US to do that, because again, the sales tax will be different by location. So just for my test file, I'm going to have the 9801 Easton Drive, Beverly Hills 90210, and that's just a made-up address, of course. Do you need to collect sales tax outside of California? I'm going to say no, I don't. That will simplify things, hopefully. And then they're setting it up. Automatic sales tax is all set. So now I can create an invoice if I so choose at this point in time, and then I can populate it, and it'll help me to calculate the sales tax. But before I do that, I'm closing out the invoice now. Then you would need to set up an item that we would be including the sales tax. Here's the sales tax calculation. I'm going to go set up an item now. And I'm going to do that by going to the Sales tab. And let's go to the Products and Services. And then if it was an inventory item that I'm going to be setting up, I can go to New Item up top. I would set up an inventory item. That means you're tracking the inventory within the system. So we talked a little bit about inventory in the past. You might use it. That would mean that you're using a perpetual inventory system. You might have inventory, but you're tracking it outside the system, in which case you might create like a non-inventory item or a service item. So I'm going to create, say, a non-inventory item here. And I'm going to say, so I'm going to call it item 1, item sales tax. Just that's what we're selling. That's the thing we're selling. A very strange thing we sell. And then the description is going to be that, and I'm going to make then the dollar amount. I'll just make it 0 for now so I could populate the dollar amount later. It's then going to go into sales, so it's going to be included in the income line item of sales, and we're just setting up our item. So I'm going to say save it and close it, and then let's add a plus button. We can either create an invoice, which will increase the accounts receivable, or if we made the sale at the same point in time, in day, like on more of a cash basis, we're going to record the sales receipt. So for now, let's go to the sales receipt and skip one step in the process, not going through accounts receivable, but we still have to record kind of two sides of the thing if we're going to use this process to use the bank feeds. So let's say this is going to be customer number, let's say 3, customer 3, and then the date, I'm going to save customer 3. I'll put it in some point in the prior year, so let's say 07-15, let's make it 05-15-20. We're going to create our sales item down below. I'm going to say it's going to be inventory sales tax. What did I call it? Item sales tax. So there we have it, and then I'm going to pick up the rate. In order to do that, I'm going to right-click on the tab up top, duplicate the tab, close up the hamburger, and I want to look at my transactions down here and see if we can kind of match it up to a transaction that we have, so we can see a deposit and see how it might fit together. So let's say that we had this deposit of this $691.44. So $691.44 is the amount. So I'm going to go back on over and say, I'm going to say it's going to be $658.51, because I'm going to try to have a 5% sales tax to see if I can get this to work out. It's going to be a taxable item. I'm going to hold down Control and scroll down a bit. Now, it applied out the sales tax based on the location, which is great. I'm going to make it a generic problem, however, and just look at and just make it a 5% sales tax, just to make it generic. So I'm going to change the math here, and I'm going to go down and say I'm going to just make it a generic 5, override, and I'm just going to make it a 5%. and then that calculates it. It's going to say, why do you do that? I'm going to say other, confirm. So now we have a generic 5%. If I close that, now we're at the 691.44 total. Does that match my deposit here? 691.44. So now we kind of tie out to that deposit. So this deposit is separate now from the transaction we got to record on the sales receipt so that we can record the sales tax. What will the sales receipt do then? The sales receipt will be increasing the checking account, or if we put it into undeposited funds, we might put it into undeposited funds here and then deposit it. But either way, we're entering it on our side, and then the bank feeds are going to be used in order to match the transaction instead of to record the transaction. Then we have the other side going to sales for the 658.51, and then we have the sales tax calculated. So now we have the total of the 691.44. So that means that we're going to get cash of this amount. I'm sorry, cash of the full amount, and then the sales are only going to go up by the 658.51. The difference is going to go to a sales tax payable of the 32.93. So if I then say save and save that, let's open up our financial statements just to check that out. I'm going to go to the second tab, right click on it. I'm going to duplicate it. I'm going to right click again and duplicate again so that we can then open up our balance sheet and income statement. So we'll go to the reports on the left hand side. Now we'll open up the P&L, the profit and loss. And this one, we're going to do a range change up top, closing up the hamburger. Range change 010120 to 123120. Running that report. And then go to the next tab on over. And then down to the reports down below. This one, we're going to open up the balance sheet, the BS balance sheet. And then we're going to say, there it is. Ranging the changing up top on the dates. 010120 to 123120, and run that report. Closing up the hamburger, holding down control, scrolling up a bit. So now when we make the sale, then if I go into the checking account, we had an increase to the checking account, this time not from the bank feeds, not from a deposit form, but rather from a sales receipt type of form. So here it is. There's the sales receipt. That didn't go through the bank feeds yet, so we haven't kind of verified that at this point in time. Now the bank feeds would then be used as a double check to verify it. If I go back up top, and that would be like the reconciliation. So now we're using bank feeds as a reconciliation type of feature. If I go to the income statement, and then I take a look at the sales tab, we're going to the sales tab. We have this amount here for the sales receipt. It's for the 658.51. Remember that does not include the sales tax here. So this is on our income statement, not including the sales tax. We're only including what we charged. The difference between what we deposited and what we charged, what we deposited is here, what we charged to this is at $32.93. And that then is being tracked by the system, not on the income statement. It shouldn't hit the income statement even though we're collecting on it, scrolling back up top, back to the income statement, but rather goes back to the balance sheet. And we're seeing it going to be down here on a payable account, like a sales tax payable type of account here, that we will then pay in the future. Now this payable is an accrual type of thing, so that's going to mess up our bank feed feature. That's why we could use this system, and we'd have to take this extra step and not just simply wait till something clears the bank, but we might be able to work around that if we need to as well. So let's just think then, if we did this system, if we go back to the bank feeds, and then I was going to say, all right, well now let's say this one, we're going to pretend this was the invoice, or matching to the invoice. Instead of recording the deposit, I would need to match it. I'd need to go find a match for it at this point in time and look for, there it is, the match. And then when I tie it out, basically, it's not going to be recording a transaction when I do this bank feed. If I was to match this, it would simply be saying, oh, okay, there it is. We're reconciling. We're doing a reconciliation process instead of recording the transaction at this point in time. So I won't actually do it at the, let's go ahead and do it. If I say save that, so now we've matched it out. So now we've entered that in and we've matched it out. So if I go back to then the financials and I run the report, we didn't add anything new when I included that. We just matched it out. If I go back to the income statement and I run the report, for example, we didn't include anything new in the sales line item here or anything like that. There's not a double amount to it. We simply matched out the amount that was recorded from the sales tax item. I'm sorry, the amount that was recorded from the sales receipt. Okay, so now let's think about a situation where I want to depend on the bank feeds. I don't want to have to match it. I would like to wait till something clears the bank. Now, if I go back to the flow chart here, let's assume we have a situation like we make sales, for example. We sell things, and instead of recording a sales receipt every time we make a sale, because maybe we sell a lot of them, I just want to collect the payments on it, and then record, take it to the bank, deposit in the bank, and then wait till the bank feeds come through with the deposits, and then just record the sales at the end of the day. I want to do that, but the sales tax are causing a problem. I don't want to record the sales receipts here, but I have to pay the sales tax. So how might I deal with that? Well, one way you could do that is you could say, okay, well, what if I go over here and kind of figure out what our sales tax obligation will be? And we could do that by taking, say, for example, our sales. Let's say we take our sales amount, and let's just say our sales was, we make a sale of $500. That's our sales price. The sales tax rate, let's say tax rate, let's say it's 0.05 or 5%. I'll go to the home tab, percentify that, so it's 5%. And if we multiply that out, then this times this, that means we'd have to collect another $25 in sales tax. Not the rate, but the actual tax. I'm going to format my whole worksheet here. I'm going to go right click. I'm going to format the cells so I can see some pennies and whatnot. I'll make it currency and negative numbers bracketed, and then okay, and then I'll percentify this one again, home tab number percentify. So the amount we'd have to collect then would be the 500 plus the 25, 500 plus the 25. So we'd have to collect 525 so that we can then have our obligation to pay the $25 to the government. So when we set our sales price, in other words, if we want to collect $500 for the sales that we're making, we then would want to increase the amount to 525. So we're also collecting the sales tax that would be in place on the sale, if that was, say, for example, an individual sale. So that's the first thing you want to think about. You want to make sure that when you set your prices, you're setting your prices that would include the sales tax. Meaning, if you were doing that in the QuickBooks system, as we saw, if we created a sales receipt here, if I go into here and go into my sales item, and I set my sales price, then QuickBooks figures out the sales tax for us by applying the rate down here for us. If I'm not going to use the QuickBooks system, then of course I need to make sure that I'm including the sales tax in the price that I'm going to be setting, and then when we make our sales during the day, if I go back on over here, when we make our sales, we're going to be collecting the sales tax. When it clears the bank, then we're going to have things that clear the bank that include both our dollar amount and the sales tax amount. When it clears the bank, we'll simply be recording, most likely, we'll include it in the bank feeds to include an increase to the cash and an increase to sales. So now we're in the easy method. We see it clear the bank. We include an increase to cash and an increase to sale. We don't have the sales tax payable account being broken out here as we saw before, but everything's recorded to sale, and then we're going to have to make an adjustment to break out the sales tax payable. So meaning everything would be recorded to sales. So then if I go back into my income statement, for example, and let's go back on up. So let's imagine that we're using bank feeds, and this sales line is the item that we have to pay sales tax on. And we just recorded the sales, and we recorded everything that was deposited into the sales line. So this includes both our sales and the portion that we owe to the government. So now, of course, in the form of sales tax. So now, of course, the government comes in and they strong arm us and they say, hey, look, if you want to do business in this town, you need protection. And so we're going to charge you 5% of sales tax. So we're going to go, all right. So now we've got this $958.51, and we have to basically do our sales tax calculation to kind of back into the sales tax. So we got the $958.51. So that's going to be the 958.51, and now I got to figure out how much of that is going to be sales tax. So we're kind of reversing this calculation. So we're assuming we collected revenue based on this, and now we got to figure out how much of that revenue we got to pay in sales tax. Now you might think you would take that number times 5%, but that's not quite right because we need to kind of reverse this calculation in order to get there. And one way you could do this is you can use a tool, and that's going to be a goal seek tool. So let's simplify this transaction a little bit. I'm going to say if the sales were 500, and we'll use the same example as our starting point, and then I multiply it times, what rate do I have to multiply it times to get up to the amount that we're going to be collecting at? So that would be equal to the 105%, 100 plus the 5% sales tax. So now I'm going to say 1.05 or 105%. I'll percentify that. And this will get down to the collection line here a little bit quicker. So we got the 500 times the 105. That gives us our 525. So now let's imagine that we've collected all the revenue. So we know what we collected, meaning we know the bottom line number. Let's imagine that should be this 958. That's what could be this number. We need to kind of back into what the sales line item is, the difference being the sales tax. So if I collected all the sales and sales tax, then I have to back into the amount that I've got to pay. I've got to pay the local tough guy, or I mean the government. Then what we have to do is then say that we got to back into it. So I know the bottom line number. So let's go ahead and do the same calculation. I don't know the top number, right? This is going to be the yellow number. We know this is 105. We know the bottom number I'll put down here should be this 958.51. So I'm going to kind of back into this calculation. I'll do it this way. I'm going to make up a number up top, let's say $100, and then we'll multiply this out. This is going to be this times the 100. And then I'm going to use goal seek to tell Excel to kind of figure out what this amount should be in order to get that to what we know it should be, the 958.51. So obviously you could do algebra to do this, but I think this goal seek calculation is useful to know. So I'm going to go to the data tab, and then the forecast, and then the what if analysis. We'll do the goal seek, and then we're going to say we want to set this cell to be the 958.51. We want to do so by changing this cell. So we're going to use just trial and error. Within QuickBooks, we'll just do trial and error to figure that out. So if I say, okay, do that, so there it has it. So now it figures out that if we collected 958.51, and that includes sales tax, and if we back out the portion that is sales tax that we're going to have to pay, the government, then that means our sales that we charge, not including the sales tax, is the 912.87. The difference between the two then is of course the sales tax. So that means of the 958.51, we have to pay the government the 45.64. So this is a way we can kind of back into the sales tax that we owe without using, the sales tax widget tool within QuickBooks. So in other words, if I go back on over here, we're thinking about a system where we have to pay sales tax, but what I'm going to do is just include the sales tax in the sales price when I make the sales. And then I'm going to make the sales, wait till the sales clear the bank so that I just record the deposits with the use of the bank feeds. Then when I record the deposits, they're going to be increasing the checking account, and the other side's just going to go to sales. But sales will be overstated because it will be including both the amount that we charge for sales and the amount that the government forced us to collect on their behalf. Then we're going to have to reduce the sales when we make the payment to the state for our sales tax obligation by calculating and figuring the amount that should be backed out. And we could do this calculation to do so. In this case, figuring that we owe $45.64 to the government. Then we pay that to the government, decreasing the checking account, and the other side then is going to go to sales, basically decreasing the sales amount, bringing the sales amount from 958.51 back down to what it should be, 912.87, which is the amount that we, in theory, charged, not including the sales tax that we were forced to charge as basically a tax collector, from the government. So that's another way that you can kind of think of to simplify the sales tax. So in summary then, If you have sales tax, it's going to complicate the system to some degree. You could still try to do it kind of on a cash basis method and back into the sales tax in the method we talked about here. Or you can, of course, set up the sales tax and use the invoice and the create sales receipt to record the sales tax as you create the sales, which will increase a payable account. And that'll help you to then pay off the payable account. The payable account being an accrual type of option. Therefore, if you use this system, then you're going to have to do some kind of matching type of system with the bank feeds to get everything to tie it out.